Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another edition of the weekly economic review, this time for the week ending April 30th, 2021. So, as usual, I'm joined by our chief economist, Thomas Gignac. So, good morning, Mr. Gignac.
Good morning, Sebastian.
All right, I'll start with the market action this week. So, an interesting week because we had negative returns on bonds. That means interest rates are still moving a bit higher, minus 0.4% for the long index. And year to date, we are slowly getting back to minus 12% on the year for long bonds. So, as this strong negative performance year to date. In equities, a very interesting story because if you look at the leftmost column, every market had positive returns in local currency this week, led by the TSX. But when we bring everything back in Canadian dollars, which is what's most important for you as investors, well, the Canadian dollar was so strong this week, 1.6% gain on the week, that every foreign market now flips to negative, so minus 0.8% for the S&P 500, minus 1.3 for EFI, and minus 0.69% for emerging, and we remain at 0.8% positive for the TSX. So a strong outperformance of Canadian assets, Canadian equities this week in Canadian dollars. The year to date, if we all again look at Canadian dollars, well, 11.45% for the TSX, and then you have the S&P 500 at 8.7%, all the way down to 2.5% for the emerging markets. So price of oil was higher again this week, 4.6% positive at $65. Canadian dollar very strong, euro stronger than the US dollar, and the price of gold was a bit under pressure this week. So when we look at COVID situation, what it seems on the left-hand chart that the third wave is now more under control, I would say. So in the Eurozone, the number of new cases is moving lower, and Canada also seems to be moving lower. In the US, the pace of vaccination is so strong that we're starting to see the benefits of it. And again, the number of cases are subdued. On the right, you see that Canada now is close to being in the top performers for the pace of vaccination. So now 30% of the population has at least one dose. That compares to 42% in the US, and it compares also pretty well compared to most of Europe. So good news there. Um, Around the world, still the number of cases are rising. We are seeing records every single day. The most new cases in the world for a single day, but it seems to be led mostly by India. In the left-hand chart, you see that India is responsible for the recent burst in the number of cases worldwide, and more frightening on the right, you see the positive rate for in India for the number of cases. So is at 20%. So 20% of tests come back as positive. That compares to only 2% in January. And the chart does not show any signs of stopping. So it's still something to watch, even though in the developed countries it's going better. In emerging countries and India specifically, the risks are still alive and well. Going to the economy now, the V-shaped recovery of nominal GDP is complete in the US. It's not the same for real GDP. Real GDP remains a little bit below where it was in early 2020, but in nominal terms, so in real dollars, in dollars, we are back above, so the V shape is complete. We had 10% growth in Q1, and Q2 is shaping up to be even better than that. So the good news keep on coming in the US and should continue to come. We had the personal spending this morning, which was very strong. Personal income jumping by 21% in March compared to February because of the new stimulus checks that hit the bank accounts in the States. The savings rate in the US is very high. It's at 27.6%, and it's not really that people are have just become savers. It's just that the checks are coming in and they can't spend that money fast enough because of the restrictions. So you have all of this pent-up demand that should continue to support economic growth for quarters and maybe years to come. Also, more stimulus down the pipeline in the US. So Mr. Biden, after announcing the 1.9 trillion stimulus early this year, then the 2.3 trillion infrastructure plan that was proposed in the last month. Now 1.8 trillion on top of that for workers, students, and families. So the American Families Plan, it should be focusing mostly on what we call supply side reforms, so helping with childcare, so helping families, and should be financed over the next decade by rising taxes over the most wealthy Americans. So we'll see where we end up, but that's a lot and a lot and a lot of stimulus that is being added to an already hot economy in the States. Finally, Canadian dollar, everyone following the news, if you're doing some home improvements or having a house built, you know that the price of lumber has gone hyperbolic, it seems. But and then when you look at the price the Canadian dollar, you see that it's rising. Well, these two things go together. On the left you see the light blue line is the Canadian dollar. It's been rising since the lows of 2020, but the dark blue line on the left, this is the export weighted commodity price index. So Canada exports a lot of commodities. The prices are rising. So as you can see on the right, the price of lumber is pushing the price of commodities exported up very strongly, and this is helping the Canadian dollar. Also, the price of oil, the price of gold. So those are all factors that are supporting the loonie, and we are fully expecting the loonie to go all the way to 85 cents somewhere in the next 12 months easily. We think the tailwinds are very important currently for the Canadian dollar. So that wraps up the economic part. So now for the financial markets, I will hand it over to you, Mr. Gignac.
Yeah, thank you. I found very interesting, Sebastian, when you refer to the figure that we have in US and even Mr. Biden, who will in fact inject additional money. Because correct me if I'm wrong, but we have the breaking news this morning, just before we record that weekly capsule, that the saving rates for the last month has reached something above 25%. Is it the
Yep,
case in US?
exactly 27.6.
Wow, think about that, the pent-up demand and the that looked like that the U.S. economy will be very strong in the second half of this year when this vaccination will be almost completed. So will be something to watch. And that set the table by me for my first slide when we talk about the Federal Reserve, because it was basically a non-event this week, this meeting. Of course, nobody expect they will change Fed funds anytime soon or reduce the QE. But even the tone of Mr. Powell was that we need much more progress before we consider reduce the QE. We are optimistic that inflation pressure will be temporary, all this kind of thing. So I think that if it was perceived as a non-event for capital market this time, I'm just curious to watch for the next time, 6 months, not month, 6 weeks from now, excuse me, when we will have the meeting in June. I think the capital market will be much more nervous. So we will see, but it will be interesting because so far, of course, we have 8 million people still unemployed in US. But at the end of the day, with what's going on, with so much liquidity, with so much saving rates, it's a big bet for Federal Reserve to believe that it's temporary, the inflationary pressure. And because in the past, in the last 3, 4 decades, the Fed has been preemptive. Why the Fed moved before the inflation accelerate is because they have a transmission lag between acting and the result and impact on the economy. This time, they will be no longer preemptive. So hoping I'm wrong and the Fed is right that inflationary pressure will be on temporary, because otherwise we could have a surprise that this business cycle will be probably shorter than usual if the Fed have suddenly to react strongly a year or 2 years from now, as we will see. Shifting gear, going to, in fact, bond market. Here you have illustration, the relationship between the 10-year treasuries, which is the white curve, and the other curve who represent the copper to gold ratio. The rationale is that the copper reflect more the economic activity, and when we have a copper price, in fact, accelerate compared to in the commodities, if you want, market compared to gold, that suggests the economy accelerate, and at some point, it's a leading indicator for the 10-year treasuries. Remember, Federal Reserve control Fed funds. They do not control the 10-year treasuries, the long rates, beyond the fact they have a QE that to affect, of course, the long rates. In fact, when they will exit strategy of the QE, clearly keep an eye on that chart. Because it's a significant probability that the 10-year treasuries will trade above 2% this summer. And Sébastien and myself believe that we will be closer to 2.25 by year end, even if the Fed do not move. So we will see. And maybe the normal rate, the fair value of the 10-year treasuries could be closer to 3% 2-3 years from now than really 1.6%. That's the reason we reduce the duration in the portfolio, in the managed portfolio that Sébastien and myself co-lead. And now we have Tej, our new colleague, who is co-lead with us as well as portfolio manager. Next chart, we have, and the last one is the stock market. We have, in fact, good news. Clearly, it's very surprising how strong are the result on earnings. 70% of the companies already released their earnings, and guess what? This chart illustrates that 85% of the S&P 500 beat estimate. So this is the highest ever seen, as you can notice on that chart. So it's spectacular. And our colleague, portfolio manager, Jean-Pierre Chevalier, responsible of U.S. equities funds, thematic innovation fund, explained to us this morning that compared to April, early May next year, they have no PE expansion because the 1,000 point additional on the S&P index come from basically of our earnings. So we still trade at 23 times, 20.5 times forward earnings. It was exactly that at the end of April last year, and this is the case right now. So I found that interesting. Who could thought a year ago, Sébastien, that we could have this kind of result? And notice I conclude on that on the right side. The market cap of global equities now exceed $110 trillion, up 28% from the pre-pandemic level. So it's amazing result that shown that when the policymaker doing the right thing, like they have done with Federal Reserve inject liquidity, backstop on corporate bonds, and government react quickly to avoid depression. In fact, that have an impact, including on the stock market. That's it for me. So we have a lot of things to watch, Sébastien, next week. Huh?
Sure. Yes. Next week we'll have a big week because it's jobs week. We'll have both the jobs creation and the unemployment rates on both sides of the border. The Canadian unemployment rate should be higher than the one in the U.S. because of how they measure it. But remember the stats that we mention every month. Now in Canada, it's over 90% of the jobs that were lost that have been regained. In the U.S., we're between 60 and 65%. So the Canadian labor market does actually much better than the one in the US when you measure it with this metric. But last month, we'll see if jobs were still created in Canada because of this third wave that closed that shut a big part of the Quebec economy, the Ontario economy, and also restrictions in other provinces. While in the US is the opposite, we are reopening. So we'll see in the US it's expected to be close to 1 million jobs added. In Canada, it's not sure that we'll have a positive print, but we'll see where we end up. We also have the ISM Manufacturing and Services Index. Both should be in the US, both should be higher than 60. And when you're in that zone, that means that you have very strong growth. So this strong growth continues in the US economy. So to follow us, ia.ca/economy. Everything we produce gets there. If you haven't done so already, you can subscribe to our newsletter by entering your email address in the box on top. Thank you, everyone, for your trust. Thank you, Mr. Gignac, once again.
Yes, sorry I was on the mute. Thank you, and have a nice weekend, Sébastien.
Sure, thank you, you too, and everyone out there. And we'll be back next week with another edition of the Weekly Economic Review.